Good morning, ladies and gentlemen. Today we're going to be going over option strategies explained. Probably one of the most requested videos on the channel. I'm getting a lot of questions recently on the channel about options, define risk of options, how people are basically a lot of, I would say, misinformation maybe out there of what exactly is defined risk for options with not defined risk for options. And I'm basically going to try to unravel that for everyone here. So basically, the first thing that we're going to go into is how options really work. And I think this is the core example that everyone has to understand. Remember, in any transaction in the market, there's a buyer and a seller. No different than an option contract. An option contract is what is called a derivative. A derivative basically has a buyer, has a seller, same way like an equity. When you buy shares, there's someone that is selling the share and someone that is buying a share. The broker just connects the two together. Option brokers, which trade on a different index, the CBO, I believe, we're going to talk specifically about calls first. So I always talk on the channel, people that buy options are not the smartest or sharpest tool in the shed. I don't believe that buying options is a viable way to make money in the market, only selling options. And we'll kind of get into that shortly. So if you are a buyer of a call contract, you have the belief that the underlying asset will increase in value and the associated contract will go up. So the way you open that is to buy to open. You're going to hear buy to open and sell to open as well, along with buy to close and sell to close. All different terms, just basically think it's the opposite of how you open that contract. So if you're a call option holder, like we covered in basically the Greeks video, which I will have linked down in the description below, you're going to need to watch that if you don't understand option Greeks. If you are a buyer, you're going to have a call contract that has a positive delta, meaning as for every dollar the underlying asset, being the stock, goes up, you have an X increase in the value of your contract. Then you're going to suffer theta. Naturally, as a buyer, you're holding that contract, so therefore you're going to take the theta hit every single day, and then you hope the asset is going to go up. Now, if I'm the reverse side of that transaction, I'm the seller of the option. So there's multiple ways I can sell you that option, and that is how your brokerage basically defines covered calls, and you can do it through strategies. Basically, it's by selling a call contract, I am giving the right to someone to force me to sell 100 shares of that company at a set strike price, being the strike price of the call option. So basically, if that contract goes in the money, since they are the buyer, which is the right to buy those shares at a set price, I have to then transfer my shares to them in exchange for the asset value at the X strike price times 100 shares. So basically, I get the money in return. Naturally, you can't sell a call contract. Well, you can if your broker allows you with a excessive amount of margin, and that is where if you naked sell, you're going to hear naked because a lot in this video because it basically means that you have complete exposure. That is where you get infinite risk. Why do I say infinite risk? Because a call option contract can go infinitely up in value, meaning your losses can be infinite. So just keep that in mind, guys, that is why you are most likely never going to be trading naked options, because your brokerage doesn't allow you to have that margin risk. What is margin risk? Basically, you don't have the money to cover, and it's just, think of it like just going and spending your credit card limit 4 times over and not paying it back. So your brokerage will force you to either use a strategy, which we're going to be covering in this video, or selling a covered call. Covered call is when you have 100 shares of the underlying asset at a certain price that you bought them. You have a dollar cost average price of that share, and basically you can then sell a strike of any kind that you want. Most likely recommend to sell one above what your dollar cost average is. Therefore, if it goes in the money, you have a profit on the contract, plus you keep the premium. That's the other thing. When you are a seller of the contract, you are receiving that premium. The only time that you don't receive the full premium is that you basically buy to close. So that means because you sold the contract in the beginning, you're then buying that contract back to close the transaction. You have a selling of the contract to open it, and then a buying of the contract. So you see how the net transaction results in basically zero, where you have a buy and a sell of the contract. That's going to be very important when it comes to strategies. It's basically how strategies revolve around. The equation has to equal out. The put side is the exact same thing. All we're changing is basically what the belief is of the seller and the buyer. The buyer believes the stock is going to decrease. The seller believes the stock is going to increase. And for a put, instead of buying, because remember, a call contract is where you are forcing someone to give you those shares. A put contract is someone forcing you to buy those shares at a set price. So it's the reverse. So the buyer of the put contract has these shares to give you, and you're going to give him money in return. Whereas the seller, you're selling the right for someone to force you to buy 100 shares of the company. So that's why we talk about on this channel that it's an excellent way for cash secured puts to basically take advantage of companies that you really want to buy, but you don't really want to necessarily wait around every single day for that stock to go to that price. You sell a 6-month out covered call on that strike that you want, and then you just let it play out. That's one of the things that we've talked about in strategy. But cover calls, again, you're balancing the equation through the selling of the contract, through the equity that it's going to cost you to purchase that. That's basically how you're covering it. You can't sell naked puts, again. So your brokerage most likely, and I'm pretty sure, will not let you do that, especially unless you do a very advanced options. And at this point, you're not watching that type of video. So what is basically strategies all about? So strategies are all about risk management. They're defined risk. There is, when you enter the contracts and you enter the trade, there is a defined risk that you're going to basically max loss. There is no infinite loss. And that's the beauty of options. It gives you defined risk. You can test a theory out. As I would say, it's not really a theory, but you test your belief and you have a set amount of risk. So first of all, we're going to get into what it means for options and basically like the different strategies that are out there. I'm going to go through the two most common that I would basically start anyone off on understanding before you get into like calendar spreads and all this, is basically vertical spreads and iron condors. So if you guys haven't seen this website ever before, OptionStrat is an excellent website to understand and try to price and see how options actually work, and specifically strategies. So we're going to basically go to the build section here, and you have your long call, your long put, so you can see the option value or the contract's value or strategy value as it goes over with time. So we're going to start off with basically what I like to trade is bear call spreads. So a spread is basically a contract that sells a closer to in the money contract and covers that through the buying of a further out of the money contract. So I know that's a lot to unpack. So you're selling a contract and then you're buying a contract to cover the underlying basically risk that you're taking to the brokerage. Because if I'm selling, let's say S&P 500 for May 19th, we're going to use this as an example. I'm selling the 407 call, meaning that I technically have infinite risk. I'm then capping my risk through the buying, because remember, you have a sell, so it's -1, and a buy of +1. So I'm basically buying the 412 option in order to cover the execution of the 407 if it falls in the money. And that's basically your defined risk. So right here, my max loss is $158, with my max profit being $342. Now, you're gonna hear spreads that are debit and credit spreads. So all the differences between the two is, do you believe it's bullish or do you believe it's bearish? So debit spreads is basically, think of it as like buying an option, but you're capping your theta and you're capping your profit, but basically it lets you use less capital to buy those options. For example, I'm going to pull up the Tastyworks account real quick just to show you guys. So right here we have the S&P 500. If I were to buy, and I'm going to go over debit spreads first so you guys can understand. If I were to buy, let's say I'm bullish on the S&P 500, and I think by May 18th, it's going to be at $415, or let's say $413. Let's use that as an example. But in order to do that, I basically have to pay $166 and my max profit is infinite, but my max loss is 166. Well, what if I'm not too confident in my thesis per se? I don't want to spend $166. I can then sell a further out of the money call to basically lower my debit that I need to basically pay, because by selling the option, I'm taking a credit. However, because I'm making it, this is a directional play, guys, is that I basically have right now a negative 15 theta. So I'm going to lose $15 every single day. By selling the 144 option, I'm basically now lowering my theta to $1.54. So I have more time to play out my theory. However, my max profit is capped at $56 now versus before, if I were to get rid of this leg, I have infinite profit. So by selling this, I'm capping my profit, but my max loss is $44. That's a big difference, guys, from $166 max loss to now $44. And yes, I am capping my profit, but I rather have a small position to try that out versus really losing my mind. And also, you only have $2 now in theta. So let's say market opens on the 15th, and by the 16th, I don't think my theory is going to play out. Well, and let's say we're basically stagnating. I don't think we're going to get up here. So I've theoretically only lost $5 or $6 versus losing nearly $40 on the previous contract. Spreads basically lock your profit or minimize your profit, but they also allow the Greeks to work in your favor, because right now I'm only taking a $2 theta hit versus the $15 theta hit, and my delta is lower because naturally my max profit is lower, but it just caps the debit that I would have to pay. And with that, you can basically test out different theories with a smaller cash collateral that's needed. And remember, all strategies have a max loss capped, meaning no matter what happens, that my max loss is $44. Even if the market goes completely sideways, the max loss of $44 on all strategies, it's always capped. It's never ever changing that way. So going back to the basic option strats. So jumping to basically bear call spreads, we're basically it's the opposite of the transaction I just showed you. And I'm going to inverse this for you guys just so you can see if we had the same option strategy. Right here, max profit $158, max loss $343, and the wider your spread is, meaning if this dollar difference between the two, my profit goes up, but my max loss goes up. If I basically do a dollar spread in between, that's what's referred to as spread, guys, the difference between the two strikes. I have a $24 max profit and a $76 max loss. So you're capping your risk to reward, but then again, it's basically just playing it out how it's going to play out. So this is for May 19th. As you can see here, 24.14, and basically the stock has to move up and towards your direction, along with, as a debit spread, you take advantage of implied volatility, where you see when implied volatility increases, you have on the table, you can actually see day by day what the option contract is going to basically be worth. And as implied volatility goes down, you take advantage of that contract increasing in value. As implied volatility goes up, it basically hurts you because you are in a basic debit spread. So remember, you're buying the closer to the money. So implied volatility always hurts you when in spreads when you're going up. Only does it help you when you're basically the buyer of an option contract, because it increases that row value that you have. Looking at this, I don't like doing debit spreads just because, one, I'm still taking that theta hit, guys. Remember that theta is still negative on this trade. So for me, I like to do credit spreads. Now, what is a credit spread? A credit spread just basically means you get paid a premium. It's similar to selling options, basically cover calls, or selling cash secured puts, but instead of using the collateral, so for example on the S&P 500, to sell we're actually gonna clear this out, to sell a 418 call, I have to basically have $41,000. Now, I don't know about you, but I just don't have $41,000 rolling around in my pocket just burning a hole in it, because honestly I could probably do a lot of stuff with that. So what I do is I sell the 417. So now you see my, by selling this contract, basically you see you have a massive debit that you basically have to pay. And then you are buying the 418 contract. So you're covering your previous contract with this contract to basically give you a profit. So you're receiving a $15 credit. Now, this is where it gets interesting with credit spreads. Credit spreads, you want both options to expire worthless, where you basically are selling the option. Remember, you're selling the option, so you don't want it to go into that direction. You are taking advantage of theta because now theta is positive. So you will gain $2 every single day that this spread is open, but you will lose $4.43 for every dollar this moves towards your strike price, or vice versa. If it moves away, then you basically, the value of the contract goes down $4.43, meaning you profit that $4.43 for every dollar move. And basically with it, you can actually increase your max profit and max loss. The way I usually trade them is I have a wider spread, about a $500 spread for $36. I wouldn't take this transaction, but I'm just using this as an example of what these spreads can do. If we actually jump, I'm going to jump to, let's say, a weekly. So we're looking May 26th. So on the S&P 500, actually, we're going to go to May 19th. So you can see here that, like, for example, if the 418 and a 420, so about a $3 spread is $300 in loss and $28 in profit. So right now, because VIX is really, really low, selling spreads is not your favorite. Remember, you want to sell when there's very high IV. The IV on these contracts are basically 14 and some change. I should move this here for you guys. So the IV on these contracts is basically 14.2%, which is pretty low. That's the other thing when selling spreads. You have to understand what the chain normally is at. For SPY, in my opinion, the way I trade it, it's $19 to 20% is where I basically want to sell that IV. When it's at 14.2, I basically just stay away. That's when you sit on your hands. The reason is if you have a directional move plus a IV jump, so VIX is jumping, these spreads, even though let's say the market's going down, their value will be held because the IV will increase. So you have to be aware of that. And I'm going to do a very in-depth video of how I trade vertical call spreads in a separate video, but this is just a high level general information of how these option strategies work. So vertical spreads are one of my most favorite things. You can do it to the call side, you can do it to the put side. It's just, remember, how you view the transaction. Is it basically you are bullish or bearish on the stock, and use either one. So the vertical call spread, credit spread specifically, is a bearish trade. You don't want the market to go up. Same way as if I do a vertical put spread. So right here, the put that I'm selling is the 405 on SPY, buying the 402.22. I'm gaining for $218, $32 profit. That's the credit I receive. And usually I'll close these transactions out at like 75% profit. So meaning when this contract value gets down to like 0.1, which is $10, I'll close it out, collect my $20 and move on with my life. That basically, I'm looking to take advantage of this theta. One of the greatest things to take advantage of spreads is doing longer spreads, where basically that theta is going to get chewed through the contract. So if we look at, let's say, a May 26th, and we'll do the call spread for a second, you can see here that you have, we're going to keep the same width, 423 to 426, you have max profit $21, max loss $300, and a $2 theta. That's a significantly more distance that the S&P has to cover. And again, the premiums are pretty crap right now because VIX is pretty low. But as you can see here, $2 in theta. So after 10 days of this being open, the contract's basically going to be roasted to nothing. And on top of that, the S&P 500 would have to go all the way up to $423 in the course of 2 weeks. Yes, it's possible, but you're basically playing a very low probability. And usually you have to look at what the delta is on your strike that you're selling. So right here, it's a 0.09 strike, so 9% chance that this option contract expires in the money. It's very, very low. That's why I like playing these higher probability trades. I wouldn't necessarily play, for example, like right at the money spreads, because yes, your profit is higher, but your max loss is also higher, and it's not a high probability trade. As you can see here, is 64% chance that it falls 50% in the money, versus if I go back up here to this, you have a 96% chance of 50% and an 86% chance for worthless on expiration. So I like playing higher probability trades. So that's basically credit spreads in a nutshell, guys. It is a defined risk trade that basically is instead of having to use collateral or shares, you're using another option contract to offset the value of the spread to basically balance the transaction out. As you can see here, -1 and +1 for the contract. So you're basically going to have to look at this area here where you're basically right at where is a -1, it balances. As you guys can see here, the contract basically balances itself out, -1, +1. So you're balancing out the two legs of the contract, totaling 0 contracts, the 0 calls. When you add this all up, you have 0 calls or 0 puts. So that's how a spread works. It has to basically equal out. Now, moving on to the next favorite option strategy that can be taken advantage of in a not so volatile market. And this is specifically for companies maybe that you have a dividend on. It could be an interesting way to, if they don't really move, it's one of those companies I think I like to play. Like Pepsi is probably a good candidate for one of these. So we're going to go to build and we're going to go to Iron Condor. So an Iron Condor is just a really fancy way of selling two spreads. You're selling the put spread and you're selling the call spread. And the whole purpose of an Iron Condor is to basically theta burn both sides of the contract. Remember, when we're basically selling the option contracts that we're going to use SPY as an example, you're selling I'm going to use a 1 strike distance. So we're selling the 423, 424. I have a credit of $9 and a max loss of $91. Now I'm going to sell the put side for the same width. So if I sell this, now I have 4 contracts that I've opened. My max loss goes down and my credit goes up, along with my theta being $1.01, versus if I take out the bottom leg here, it's only 80 cents, versus also if I do the opposite, 0.38. So I'm combining the theta of each of these contracts basically, and what I want is for neither sides of this condor to be hit. So you want the stock to basically go sideways. As you can see here, as you go closer to expiration, you're gaining that profit. Your basic theta, remember, picks up. Remember in the video, the previous option video that I explained, theta increases as time goes on. So you don't want the stock to have a high mobility. Right now, S&P and NASDAQ would be a horrible choice for this. But if you find a company that basically has a historic range and you can play 2-3 month out Iron Condors on companies that don't have a lot of movement, and you really don't care for those to go all the way to expiration, you're just trying to collect that time premium. So for example, how would that look on the S&P 500 if we were in, let's say, a bull market? Now, I'm using this as an example. I don't recommend doing this necessarily, guys, for the S&P just because of how volatile it is. Let's say we went to October strikes and we did a 1 standard deviation. That's what the blue line here signifies on Tastyworks, is where basically the delta of the contract is sub 0.15, or depending on time that it's out there. But right here, 470, 475 on the S&P 500, and then not going below 355 into October. That theta is 46 cents on the day, but the delta is basically a nothing burger. So you're just building this contract in order to have time. So jumping over to option strat to just see how that would visualize over time. So as you can see here, basically the contract doesn't really have a lot of value going into May and June, just because with Iron Condors, you don't really get that theta to pick up until the last 2-3 months. However, you're basically looking at your max profit is $82. So would I ideally design an Iron Condor for this many months out? No. Also, IV is pretty low, so that's the other thing you can do is when IV spikes on a company, and usually through VIX or something, you could play an Iron Condor to take advantage of the volatility crush on both sides of the contract, the same way with theta. So if implied volatility were to be higher, let's say, then you see here, you're basically getting more in the red, but that's when you initiate the contract. If we go back to what it's originally now, and let's say you get an IV crush, just to show you guys an example, let's say IV crushes, you see how it all turns pretty massively green. Case in point, you don't really sell option contracts when IV is very low. That's why you have to understand how VIX trades, where VIX is, and to keep thing about option contracts. That's why I go back to, you have to understand where the chains traditionally are during high IV and try to target trades on options when there's a high IV. So basically with an Iron Condor, you really don't gain a lot of value until the last 2 months. You can see here, if the stock basically trades within a 5% range in that September-October timeframe, you get a massive amount of money. And then you just basically want the stock to go sideways. So ebbs and flows, as you can see here, if it goes up 4%, you're taking a small loss. And then naturally, if the stock has a sharp movement from the time you originate the contract, it's probably going to have an IV spike, and you're not necessarily going to be positive on the contract. But then again, you have time on your side. You have all the way till October for the contract to basically even out and go here. Now, where I basically would say that you have to modify the contract is when one of the legs starts getting touched. We're going to cover that in the Iron Condor video that I'm going to create in a few weeks, where basically giving you an in-depth guide of how to trade Iron Condors, but just giving you an overall general thing about option strategies right now. So going back to the option strategies, Iron Condors are an excellent way to basically play long-term, not high-moving stocks. Again, you have to understand IV. So you got the two, my favorites in opinion, is the Iron Condor and vertical call spreads and vertical put spreads. Those are the two styles that I like to trade, and that's where I'm most knowledgeable. If you go to option strat, you can actually see that there is a plethora of different strategies and different things. Butterfly, Iron Condor, reverse Iron Condor, short put butterfly, all these things. If you don't understand strategies, I'm gonna give you the advice of start off with these simple ones: debit spreads, credit spreads, and then neutral with the Iron Condor or Iron Butterfly. Iron Butterfly, all it modifies is basically you're selling a put and a call on either end, and then buying basically an option, two option contracts to cover in the center. It's just, it has a higher collateral requirement versus an Iron Condor, and then how its profit metric is done is just basically modified slightly. So those are two very, very simple strategies. And as you guys, I want to see the reception you guys have for these type of videos. I want to see what you guys like about it, where you want me to basically explain certain things better. And then we're going to get into a lot more of these in individual videos of how to trade them. But I just wanted to give you guys a insight into strategies, kind of clearing up some of the misconceptions that have been out there. If you guys have any questions, throw them down below. I love to interact with you guys, and it'd be a good setup for the next video. So if you got a specific question about the verticals, put it down and I'll make sure I'll cover it in the next video. The Iron Condors, all of it. It really helps if you guys give me feedback on it to then tailor those lessons and answer those questions, because maybe a question you have, someone else has, and they'll learn from it. So with that, guys, I hope you enjoy this video. Let me know what you think, and I hope to see you in the next one. Have a wonderful day.